Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Will Nasgovitz, CEO of Heartland Advisors, and Jim Smigiel, Chief Investment Officer of SEI. We're here to discuss why small cap stocks have been challenged and if the market will start to broaden out. It is great to have the both of you with us, and let's just talk about some background here for a moment. Will, what are your thoughts overall when it comes to the macro environment and what's been sticky inflation and interest rates, which of course are particularly impacting smaller cap stocks?
Sure. Well, it's great to be here, Jill. We're focused on the micro, but you got to be paying attention to the macro. And I think GDP probably caught investors by surprise last year. Now the question is, what's the sustainability given the degree of fiscal stimulus that we saw that really drove that above trend growth, perhaps? And look at the real-time indicators, the consumer present situations, less expectations at recessionary levels. The ISM has been sub 50 for a number of months now. So to us, it points to probably a slowing, perhaps recessionary backdrop. And that doesn't deter us, because a lot of equities that we're looking at or own, we think have discounted a lot of those negative news or challenging environment ahead of us. Don't get me wrong, if we have a recession, there's downside, but we like to think what we own, there's less downside there. So overall valuations for us seem quite attractive, and we think that investors want to focus on the other side of this pending slowdown.
Yeah, and Jim, it feels as if the economy certainly is very bifurcated, where it's impacting the lower end consumer, as an example, relative to other areas within the economy. And you can almost say that the same thing is translating to the market as well, where there are the haves and the have-nots in terms of performance.
I think that's right, Jill, and I think the corollary is exactly correct. I mean, we've been talking about sticky inflation. We have 3 or so hot prints, and then maybe things have leveled off a little bit. The market has been kind of kicking the expectations for Fed rate cuts down the road. We started off at 6, now we're down to call it 1.5. From the consumer's perspective, that inflation is cumulative, right? I mean, this idea of a decrease in the increase is something that I think gets lost on market participants. It certainly doesn't get lost on, I think, the average consumer, and that AI fever that has really been the key driver of markets in 2023, and certainly again here in 2024. That doesn't lift all boats, and that's certainly what we've seen when we look at things like the headline cap weighted S&P versus the equal weight, or large cap versus small cap.
Yeah, and that's a great point that you bring up, because the way the consumer or the everyday person who's not in the markets is perceiving the economy. I mean, there are surveys out saying that they believe we are in a recession, that unemployment is as high as it's been in 50 years. Meanwhile, the stock market's at all-time highs, and perhaps their retirement accounts, if they are invested, are performing well. It's just this day-to-day perception in terms of how less the dollar feels like it can be stretched. And that can also be amplified because we're in an election year. It's a big talking point. I don't think that's something that's going to go away anytime soon either, just in the narrative.
I agree. This has been very much of a Wall Street versus Main Street, and Wall Street has been absolutely positively winning in this scenario. And when you have that type of situation in an election year, there's going to be some, I think, volatility at the polls.
Yeah. And Will, I mean, the narrowness of the market certainly does stand out. And the question is, are there expectations that it will start to broaden out, and perhaps where those opportunities could be outside of the exception that valuation?
Sure. No, it's a great point. I mean, the narrowness has been talked about a lot, but the data is quite striking. I saw the other day, like 20 to 30% of the S&P 500 constituents are outperforming the broader index. Typically it's around half, and that hit rate today is rivaling what we saw in the 98, 99 timeframe. If you go down to smaller mid-cap securities, that hit rate is a lot lower. So I think the catalyst, Jill, perhaps why that broadening out could happen is I think strategic buyers are starting to pay attention to this. We've had, in just the last month alone here at Heartland, 3 of our holdings acquired by strategic buyers, and it's broad-based. One was an industrial, one was a bank at a sizable premium, and another was in consumer staples. So my sense is a lot of business development teams at the Fortune 500 are noticing the valuation disconnect, the lack of participation, the lack of interest, and perhaps that could be a catalyst for small and mid-cap securities in the back half of 24 and in 25. Yeah.
And Jim, I see you're shaking your head as well. Perhaps it's not necessarily, one sector or all, boats raise all, all tides raise all boats, that perhaps you're investing in the companies specifically, especially in the small cap space, relative to this sector where everything's moving in tandem with each other.
Yeah, I think that's right. I mean, I think our outlook for the remainder of the year is really going to be one of bottom up as opposed to being top down. I mean, I think Will talked about the M&A activity. That definitely is a benefit to the small and mid cap. We certainly agree on that. We also think there could eventually be some kind of flows turning against kind of the cap weighted indice. I mean, I think passive investors, this has been a great environment for them, but at some point they have to take a step back and realize that they're buyers at any price. And that 35 cents of every dollar they put into the market is just going to a very small subset of names. Now, it's great when those names are absolutely on fire and when NVIDIA has $1 trillion in 23 trading days, but that's a bit more of the anomaly. And I think, those dedicated passive investors would do very, very well looking to kind of broaden out, even, dare I say, think about getting large cap active management back into their portfolios just for some diversification.
Yeah. I mean, well, even for small cap as well, let's say, for example, you're benched to a biotech index. If you look at the 300-400, the tail of those indexes, I mean, that's just such, those tend to be more volatile because there really is no proven track record, but they happen to be part of an index. So you really do have to pick and choose your spots in sectors like biotech as an example.
That's exactly right. I mean, active management in small cap has had a huge tailwind recently. It's been a great market. If the investor is just taking a step back and looking at the beta returns of the Russell 2 or the S&P 6, they're not going to get the full picture, I think, of really the returns available in small cap space. I think the median manager in the Lipper universe as of May is up 400 basis points. Now, when the beta is flat for the year, understood, that's not keeping up with 15% of large cap, but it is a very well-stocked pond from an active management perspective. We think that becomes a lot more meaningful relative to all betas in the second half of the year.
Yeah. And Will, do you see, are there particular sectors or areas of the market that are more attractive than others?
Well, at Heartland, we like to utilize our 10 principles of value investing in conjunction with some portfolio construction tools to help us produce consistent returns for our clients. And using those tools, what we identify is that we have some active underweights that we just want to make sure that they don't get too extreme. So, for instance, in the small cap space, financials is an area where we have some active underweights, and we want to address that again so it doesn't get too extreme. So I think within banks there are some that still look attractive to us, notwithstanding the challenges that are out there. But like Texas Capital, TCBI is trading at 90% of tangible book value. The broader SMID regional bank universe is at 130 or 140 of tangible book. So that's an attractive valuation that perhaps could be of interest to another strategic out there.
Yeah. And Will, I would also argue too, even if we were to get 1 or 2 rate cuts this year, I mean, is that enough to really lend a tailwind to small cap companies? It's really not that much at the end of the day. And some of their balance sheets are challenged a bit.
You're probably right. I think it's always about the rate of change and the fact that we'll see the Fed easing. I think the sentiment towards the asset class, it can't get much worse, right? And you'll see more interest in that group. The volatility will be, people are more receptive to take that on because the Fed will be in an easing cycle. So you're right, maybe from an actual results standpoint, you won't see it immediately, but the overall sentiment, given the rate of change will be working in your direction, should be significant.
Yeah. Jim, it's interesting. We had a small cap panel last week, and one of the participants had mentioned that there are a smaller amount of publicly listed companies these days as a result of staying private longer, and then also private equity, snapping up a couple of these smaller cap companies. And obviously they're going to cherry pick the ones that, have the healthier balance sheet and healthier fundamentals. I mean, it could also be a result of, some of these have been cherry picked out of the market.
I think that's exactly right. I mean, the popularity of private equity is not a new story. We see it ourselves. A lot of our institutional client base is DB related. That's an area of the market that we had a hard time getting to accept anything with that type of a lockup. But in recent years, call it the last 5 to 8 years, it's been a really popular part of even a DB client portfolio. So the market for private equity has been expanding. The demand from the investor base is there, and that creates a fight for supply. So I think that's definitely a huge part of it. You can also see that if you look at the Russell 2 and track the percentage of non-earners in that index. I mean, that has been increasing relatively rapidly. That's really been a 10-year trend. And to your point, I don't think there's any doubt that a private equity influence is one of the reasons why some of those really gem names are being kept out of the index and kept out of the public's hands.
Yeah, and it was to your point earlier where you don't want to run the risk of severe performance concentration like we've observed in US large cap if everyone's kind of going towards the same sectors and the same types of stocks.
Yeah, that's exactly right, and that's where that's where active management is in some cases, and admittedly for all the viewers, look, Will and I were talking our book a little bit here, but this is a good time, we think, for active management given the makeup of the indices and given the concentrated nature, as you mentioned, but also given the macro environment. We are at inflection points, switching from a tightening cycle to a hiking cycle. The central banks aren't going to be as coordinated as they have been in the past, and of course, we do have the election kind of looming over our heads with the first debate next week. Who knew we were going to see a June debate?
Yeah, that certainly will be interesting. And Will, to wrap up here, do you think election volatility is priced into the market yet, or is it too soon to tell, or is this really going to hinge on the debate that if it takes place next week?
I think it's too soon to tell. We're obviously the election's approaching here. My sense is that any clarity on who the decisive winner might be will certainly provide a lot of confidence in the marketplace, but it's still too early to tell in that regard.
I'm not sure if any volatility is priced into the market, Jill, to be brutally honest. We're looking at a VIX below 13 still, and we've touched below 12 just last week. So, the low vol in equity space, I think that is definitely a theme that just kind of reflects this one-way ride in 2024. A bit of euphoria out there.
Yeah, well, okay, so let's continue that point there, Jim, for a moment. When things seem to be relatively complacent across the board, I mean, with our reporting, May going into June, there was that feeling it's going to be relatively slow. Everything's going to kind of hinge on what happens, with the election as we get to the end of August, September, and then going to October. And it felt, and to your point, we're seeing it in the volatility markets. And it's almost like that is somewhat of a signal that there are, some items bubbling underneath the surface. That kind of makes me nervous when everybody's like, all right, we'll take the summer off.
Yeah, and we agree. I mean, when insurance is cheap, which is another way of looking at kind of low volatility, we will tend to buy it. That might not always be the easiest thing for the end investor to do, but looking at things like quality, particularly when we're talking about things like small cap, making sure that you're buying the actual companies that have earnings and kind of staying away from that large percentage of an index which are actually non-earners. This probably makes some sense. So trading up in quality right now. We like it. If you have the ability to buy some protection on the downside, the market's giving that to you at a very fair price.
Yep, it certainly is. All right, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.